The world's largest silver exchange, COMEX, has a mathematical problem, a really big one. And it's a problem that could seriously impact the price of silver and maybe even the wider financial system. Now, this isn't speculation, this isn't some wild theory. We're simply going to look at the exchange's own public data to understand the pressure that's building up inside this market. And this lays out the core of the issue in black and white. On the left, you've got over 400 million ounces of silver being claimed through paper contracts. Think of them as IOUs. But on the right, you have just 103 million ounces of actual physical deliverable silver in the vaults to make good on those claims. That's nearly 4 paper claims for every 1 ounce of real metal. So today, we're going to dig into the data behind this imbalance and figure out what it all means. So here's how we're going to break it all down. First, we'll get a handle on this core imbalance at COMEX. Then, we'll dive deep into the inventory numbers to see just how serious it is. After that, we'll look at some other market signals that are flashing red. We'll zero in on the specific date in February that everyone's watching. And finally, we'll look at history to understand what could happen next.
All right, let's jump right in. To really get this, we first have to understand the basics of the COMEX silver market. Getting this foundation right is absolutely crucial for everything that follows.
So, the COMEX, it's the main stage where silver futures are traded, and it's what sets the global price you see on your screen. But here's the key. It's mostly a paper market. The vast majority of traders are just swapping contracts back and forth and settling in cash. They have absolutely no intention of ever touching a physical bar of silver.
Now, this is a really important distinction, so pay close attention. COMEX has 2 categories for the silver in its vaults. Eligible silver is just metal that a private owner is storing there. It's off the market and is not for sale. Registered silver, well, that's the only pile that actually matters. It's the exchange's official usable inventory that can be delivered to settle a contract. So when we analyze the health of the exchange, registered is the only number we're going to watch.
Okay, so let's move on to Section 2 and look at the heart data. Let's see what's been happening to that all-important registered inventory.
The long-term trend here is, well, it's stark. Just look at this. Back in 2020, COMEX had about 330 million ounces of deliverable silver ready to go. Today, that number has plummeted to just 103 million. That's a drop of over 70%. This is not some short-term blip. It's a multi-year hemorrhaging of physical supply.
And this number shows you just how fast that's happening right now. On average, almost 800,000 ounces of registered silver are physically walking out the door of the COMEX system every single day. The drain on this inventory is both massive and relentless.
So the crucial point isn't just that the inventory is draining, it's that the drain is accelerating, big time. In January 2024, 6.8 million ounces were pulled out. This past January, almost 50 million ounces. That's more than a 7-fold increase in the rate of withdrawal year over year. That signals a huge escalation in the demand for actual physical delivery.
This brings us to Section 3. It's not just the inventory numbers themselves. There are other market indicators out there that are basically flashing bright red warning signs of extreme physical tightness. Take the silver lease rate. Think of it as the interest rate you'd pay to borrow physical silver. Now, in a normal, healthy market where there's plenty of supply, this rate is tiny, less than 0.5%. Today, it's sitting at 8%. A spike like this is a classic, textbook signal of a severe physical shortage. The market is screaming that it is very difficult and very expensive to get your hands on physical metal right now. So the obvious question is, why don't the miners just dig up more? Well, it's not that simple. The supply is what we call highly inelastic. As you can see from this chart, a whopping 80% of all silver is mined as a byproduct of digging up other things like zinc, lead, and copper. You can't just decide to produce more silver. It's completely dependent on the demand for those other metals. The supply just can't respond quickly to price.
And the demand isn't just from investors. It's structural. It's industrial. Both the United States and China have now officially classified silver as a strategic material, something that is absolutely essential for critical industries like AI, solar panels, and electric vehicles. This isn't just some theory, folks. This is stated government policy. And it's what's underpinning this massive industrial demand that's draining the physical market.
And now we get to Section 4. This is where all these different data points, the draining inventory, the market signals, the inelastic supply, they all converge on a single critical date. Let's look at exactly why the market is laser-focused on the end of February.
This slide brings us right back to the central question we started with. February 27th is what's known as First Notice Day. It's the day when traders holding those paper contracts have to declare whether they're going to take the money or if they're going to demand the physical silver. So let's just walk through the simple math here. If just 10% of those contract holders decide they want the real metal, which would be high, but not totally unheard of, that would trigger a demand for about 50 million ounces. Boom. That's nearly half the entire registered stockpile. Gone. Now, what happens if that number ticks up to 20%? Well, that would demand 100 million ounces, and the vaults would be effectively empty. By the way, if you're finding this analysis valuable, please do us a solid and hit that like button, share it, and subscribe to our channel. That way you won't miss any of our ongoing coverage as this whole situation develops.
All right, let's move on to our final section. To really understand what might happen next, we have to look back at how the exchanges have dealt with these kinds of pressure points in the past.
History gives us a very clear playbook. In 1980, during the famous Hunt Brothers squeeze, the exchange created a new rule, Silver Rule 7, which basically made it so you could only sell, not buy. It crashed the price. Then, in 2011, as silver was rocketing towards $50, the exchange jacked up margin requirements 5 times in just 2 weeks, forcing a massive sell-off. The precedent is clear. When the paper price threatens to get out of control, the exchanges step in, decisively.
However, and this is probably the most crucial point in this entire breakdown, today is fundamentally different. In both 1980 and 2011, the COMEX vaults were full. They were sitting on mountains of physical silver. Today, they're nearly empty. The exchange can change the rules, they can raise margins, but they cannot print physical silver out of thin air. This lack of physical backing is the game-changing variable in the equation this time around.
So, all of this brings us to our conclusion. Based on all the data and the historical precedent, the situation right now presents 3 distinct core risk points that you need to be aware of. First, you have counterparty risk. This is the risk that the exchange just says, you know what, we're settling all contracts in cash and refuses to deliver any metal. This would essentially break the entire physical market link. Second, there's regulatory risk. This is the risk of a repeat performance of 1980 and 2011, where they just change the rules mid-game to force the price down. And third, you have price divergence risk. This is where the COMEX paper price becomes totally disconnected from what people are willing to pay for an actual physical ounce of silver in the real world. So, as we wrap this up, the data points to what looks like an unavoidable conflict. You have a physical supply that's severely strained, meeting an ocean of paper claims, all happening on an exchange that has a clear history of direct intervention. So the ultimate question we're left with is not if this tension is going to force a major repricing in the silver market, but rather how this fundamental imbalance is finally going to be resolved.